everyone. Today we're going to talk about finances and taxation when you sell your home. So I've invited Evelyn, who is a Central Florida Realtor, and she is also a friend, and we're going to go over the questions that she gets the most all the time when people are selling their home. So let's get started.
So Sonia, I often get the question, should I be concerned about getting taxed when I sell my home? For example, I have a property that recently sold. This was actually a second home for them, or an investment property. They only had a mortgage of about $50,000 on it, and they cleared well over $300,000. And they're concerned about what their tax liability would be.
Okay, to get started, the factors that you've given me will not give me any indication of the real taxation on the issue. If this is a second home that if they rented, did they rent?
Yes.
Okay, a second home that was rented is considered a business property. If they filed taxes properly, they were also depreciating the property. So the two factors we're going to be concerned about is, actually three. One is, what was the purchase price of this home?
When they purchased it?
Yes.
Okay, let's say $100,000.
Okay, so we're gonna say we bought it for $100,000. How much are they selling it for?
$400,000.
Okay, so now that's the possible capital gains, $300,000.
Okay.
The $100,000 that they bought it for, the $400,000 that they sold it for. So the $300,000 are the possible capital gains. We do have to go back and say, did we add a pool? Did we did we add a roof? What did we do to sell it? That also becomes part of the cost. So let's assume we put $50,000. So now $150,000 is the true cost. The selling price is $400,000. So $250,000 is the capital gain. The capital gain will be taxed at their tax bracket, whether it's depending on their tax bracket, maximum of 20% if it's long term.
Okay.
I do have to point out, there is a little thing here that they will also have to remember.
Okay.
Recapture of depreciation. If they were taking depreciation benefits throughout years, depending on how many, that has to be added back on.
Okay.
And it gets taxed. So it's a special calculation that needs to be done correctly at the time of the tax prep to calculate the real tax implications of selling a second home.
What if they didn't do that?
If they did not claim the income, which sometimes people do, then there's no depreciation.
Okay.
But it's still the capital gains that will be allowed will be based on the selling price plus all capital improvements. So in this case, let's say it was 150, purchase price plus capital improvements of 50,000, selling price of 400, therefore $250,000 capital gain. More than likely, it'll be taxed at the 20% tax bracket if they have held it for at least a year or longer.
Okay. How do you quantify the improvements?
You got to go back. You got to
Do
go
you need
back.
Receipts? Will there be requirements of invoices?
It's best. It's best.
Okay.
Reasonably, if you hold the house for a lot of years, I believe we can go back and say, well, I changed the floors once, or I did this. We have to be reasonable. Holding receipts is usually best.
Right.
Because it could be challenged at any time. But if you keep receipts is better than not.
Okay, and improvements
Use
could be
judgment.
even mechanical improvements, such as roof, plumbing, electrical, if the house is older.
Absolutely.
It's any improvement that you've poured into the home. It does not have to be aesthetics or...
Correct, and it could be aesthetics too.
Okay.
I mean, especially for a second home, there is no exemption. So everything you do to it is basically a capital improvement to be added to the cost of the original cost of the home.
Okay, and going back, you mentioned, I mentioned that they still owed some money on the property. That doesn't matter. So whatever mortgage payoff amount they have, That doesn't change their...
That doesn't matter.
Okay.
Those are factors that make no difference, because what about if you went out and got a second line of credit on the home? Makes no difference. It's the base, those factors that will matter when calculating the taxation on the sale of a second home.
Got it. All right, let's move on to one of my most recent favorites, inherited properties that have to go through probate. So I recently had a property sell locally, and there were 5 heirs. And their first question was, should I be concerned about taxes? How much should I expect to pay in taxes with my final proceeds?
Okay, inheritance. First, what we gotta do when someone, if it's been in probate, how long has it been in probate?
Let's say about 6 months.
Okay, that's not that long. The best thing to do first is to go back and get a fair market value estimate, an appraisal preferably, as to the time of death. So what will happen is the cost of the home will be as of the date of death. So if the home 6 months ago was worth, let's say, $400,000, and now you sell it for $450,000, they basically have a $50,000 capital gain tax. That $50,000 divided into 5 people, they all get to claim $10,000. That's pretty much what they would be worried about, which is pretty good.
Pretty nominal. So when somebody passes, whether they have a will or not, if there's property that's owned, the first thing that should happen is an appraisal or a market analysis on the property right away.
Yeah,
especially if the
exactly.
property is going to be sold by the heirs.
Yes.
Now, would it still be beneficial to have that done even if they plan to keep it and maybe have one of the siblings live in there?
Yes, absolutely.
Okay, so always remember to get
Sometimes
an appraisal.
people rent those properties.
Okay.
They consider it income.
Right.
Let's say that instead of selling the property, they decided they're going to collect rent and they're going to split it. So having that starting number as of the date of death will make a big difference when they go sell it 10 years down the road and it's worth $700,000.
Right. Got it. Got it. Otherwise, it would revert to when they purchased.
Correct. If you don't have that information, normally they could have bought the house for $100,000.
Right.
You sold it for $700,000. Now you have a $600,000. Right.
Ooh.
Whereas if you get the fair market value
At the time of death.
All
right.
Okay. And sometimes a full appraisal is not necessary, but a professional or a licensed realtor, even if it's an email that gives you information and comparables, could be used as a starting point to calculate the real capital gain, which a lot of people don't do, and it's understandable. Those are rough times.
Right.
But
It's the last thing you're thinking about.
Yeah.
But it's important.
It's important.
It's important. Great. All right, so we're going to go on to the investment side a little bit here.
Okay.
Are there any tax advantages or drawbacks to holding real estate in an LLC, trust, or other entity, especially an investment or a vacation property?
Taxation-wise, they all would be taxed the same way.
So there would not be any benefit and or any drawback to holding it in an LLC?
Holding in an LLC, most attorneys want that because they think that liability is important when it comes to protection for the owners. That's why a lot of attorneys say LLC. At the end of the day, the LLC is going to pay and it's going to follow the same rules for any investment. And if it's owned by just one person, it goes straight to the personal tax return. There's no real advantages in that format.
It's really more for protection.
Yes.
So for the individual that owns the property, if it's in an LLC or in a trust even.
In a trust, the main thing for a trust is that it avoids probate.
Okay.
But at the end, it's gonna follow the same rules. Whoever inherits it, whoever takes it, in the discussion we had about cost, all of that still follows. The tax bracket will depend on whether you're married, you're single,
Right. What your tax
how much money
situation
you've
is.
made. Is it, are you at the 10% capital gain in long term or short term? All of that, but the rules are not taxation wise. The rules are pretty much going to apply the same.
The same. So to be clear, people put their properties that are investments into LLCs and or trusts just to protect themselves from the liability of anything going wrong with the property, not necessarily for tax purposes, is what you're saying.
Correct.
Okay. What strategies can sellers use to minimize capital gains taxes, especially in a high appreciating market, one that we just came out of? In 2022, we saw double-digit appreciation in homes as in this market here in Central Florida. And we see a lot of folks now wanting to sell those homes that are concerned about taxes.
Okay, we can do two things. I'll start with the easiest is using Section 1031. So basically using Section 1031, you sell your home and you go buy, you use all the proceeds to buy another home. Or you have a building investment or a second home and you go buy the same thing, zero capital gains. Got to make sure you do that Section 1031 correctly and zero capital gains.
Section 1031 can be utilized for primary home?
Primary homes for Section 1031, I believe, yes, it's a real estate investment. It's a rule for real estate. Doesn't matter whether it's primary or not, whether you live there or not. As long as you utilize the funds straight into another property similar. So that's probably the easiest way to avoid it all. Now, if you are seeing a high appreciation, which you will on certain years, and you want to sell, first, I would say plan what you're doing with that property, set goals, because after you take capital improvements, costs, you could end up with a big chunk of capital gains at the end in high appreciation times. Plan better. So if you have this really high appreciation time and you have this big capital gain, maybe sell some stock that is losing money, that you have it sitting there and you haven't done anything with. So you can offset. So offsetting, that's why planning is important. How do I offset these capital gains so I don't have to pay Uncle Sam $20,000, $30,000, $50,000, depending on the gain itself.
Correct.
You can offset it with other things. So planning is extremely important and high
appreciating. And when do you start planning?
Well, when do you want to sell?
So the moment you decide to list your property, that would be the time to sit with you, a tax professional, to
absolutely
craft out the strategies.
Yeah, depending on the size, depending on the capital gains. Yes, you wanna go back and you wanna do a financial analysis of what you've got and what you're gonna do in the future with that property. And perhaps you may be diverted into doing something else that will be even more beneficial than just selling it and paying the capital gains.
Gotcha. And have other options.
Exactly.
That's great. What happens when somebody inherits a 1031 property?
The same thing. We're going to go back to the same basis. We're going to go get an appraisal or some kind of estimate of what the cost at the time of death, and it's a beauty. You get the stepped up basis of the capital gains from the time you no longer have capital gains deferred or pay or anything. You get the fair market value as your cost. So if you get it and the fair market value says $700,000 and you sell it for $700,000, you really don't have any capital gains as someone who inherit Section 1031 property. Well, a lot of interesting questions. I hope you really enjoyed it, and I hope you can really put it to practice in your own world. If you have any other questions real estate related, put it on the comments. We'll try to answer you right away, or we will make a video about it. If you find this helpful, like and subscribe, and we'll see you next time.